then this is true. This is going to be true. But if we're looking at fear and greed, would it be reasonable to consider that this is false? This is going to be false, and therefore this is possibly going to lead us to an excess situation. That's pretty obvious, right? So the key to understanding the oil last night was very simple. Figuring out how much was supply and demand, and figuring out how much was false fear and greed. Reasonable? So when I'm looking at a move, if I have a baseline here and I'm looking at a move and that's what the demand suggests, well, everything above that is now excess, right? That's everything technically above here is now excess, and I can price that excess up, because ultimately we could then say, well, this is what we would then determine to be a fair value price. All right, so we've now got a fair value price where the supply demand suggests that that's where it should be. Well, we did a calculation on this from Friday, didn't we? We did this morning in classroom. So we did a classroom this morning where we actually worked this thing out. You know, the calculation was very simple. So we had the swap dealers trading at $1.90 and a price of $74.30, $74.30, wasn't it? Price of $74.30 from last week. And then we had a price of $1.68, and it was trading at $72.80. So we obviously can then recognize that 22 cents is equivalent of, as you can see there, $1.50, right? So in other words, we're approximating about seven times on that narrative, aren't we? We're approximating about 7 times. So when I'm looking at last night's and I'm looking at this here, I can see last night's is $1.80 approximately. Last night's is $1.80. The price is 74 for argument's sake. It's approximately 74. It's close enough. So the price is 74. Okay. So all of a sudden we've now got something. What the hell's going on? All of a sudden that we've now got something we can do as a calculation, haven't we? So when we go from that there to the kickoff, and at the kickoff we're trading at, say, for argument's sake, around about, let's just make it really easy. At the kickoff we're trading 22 cents higher. We're trading at $2.02, which means that I can now look at that and say, well, realistically, this should suggest that we have a $75.50 fair value read. So realistically, oil should trade $75.50, shouldn't it? Anything above $75.50 is basically fear or greed, depending upon how you want to look at it, right? It's greed of the buyers. It's a lot of fear. There's a lot of stuff going on here. But if it's trading above $75.50, I now have what I would deem to be an excess, possibly even a very heavy excess above here. So I have information in this price, haven't I? This information contains this price. This price contains information, doesn't it? And if this price contains information, we determine this to be a low entropy storyline at that play. This price contains information. Therefore, the price above it also contains information. So if I'm now looking at that price above it and the price opens last night at $78 a barrel, look how much fear is built into that price. It's enormous, isn't it? 250 cents, $2.50 of fear is built into that oil price. And with $2.50 worth of fear built into an oil price, I want to take advantage of that big style. And we just started selling at wholesale price breaks. So, you know, selling at 78, 77.50, 77. Now, obviously, you don't want to be selling towards 75.5 because that's fair. So, people might start buying 75 halves at that stage. And interestingly enough, they bought on the drop at 75.20. On the drop, they bought the 75.20s. So, you weren't far from that story. But then from the 75.20s, they then sold the 76s, because 76 at that stage is still in a 50-cent premium to fair value at that point, isn't it? And obviously the fair value is starting to change during this changing period. The low swing was basically, not that far off the high swing. It was $1.90. So it went $1.90. So it was obviously still very much as it should be. But fair value at $1.90 should only be what? Around about 70 to 80 cents. But obviously with volatility, you'd probably say, well, give it a little bit more and let's call it $1. So you would recognize that fair value now should be about 75, right? So at this stage here last night, which is now only 1 o'clock in the morning London, fair value should now be trading 75. Anything above that is still fear. So when you trade 76s, as if we're not got an opportunity to start selling that dollar premium, sure. So 76 becomes an easy money short at 1 o'clock, 2 o'clock. And the price just keeps developing. So what happened from that point onwards? Well, we traded from the high swing of $2.04. And by the time we hit the London Open, for example, we were trading at $1.90 again. So we should be expecting to see about another 70 cents or 75 cents from that price level. So we're probably thinking 75 sell side, 74.25 would be realistic for a fair value trade. And sure enough, if we traded below 74.25, we actually traded to 74 evens, which I now thought was probably a what? A discount to fair value now. I think we've overcooked the sell at this stage. And this is how the trade played out. So I think at this stage here, we've now overcooked the sell by about 25 cents. Now, I don't think 25 cents with the momentum of the move, because I don't know where the momentum is going to take us to, right, at this stage. I've no way of knowing where the momentum is going to stop. So I'm just starting to book my profits on that discount. 25-cent discount, by all means, I'll book the profits. And then we started to see the punch through again here. So obviously you can then do a brand new calculation, can't you? The swing high here, for example, was just under $2. And the swing low, for example, here was around about $1.80. So that's a 20-cent move right there. Well, we know a 20-cent move is about $1.50, right? So if we're selling at the 75s, $1.50 baked into that is now going to be what? $1.50 baked into that is now going to be $73.50, correct? So $1.50 baked into that means $73.50 is probably fair value lows. So anything below that is now a discount to fair value. And there's your discount to fair value. See it? So we're getting this discount to fair value. Every time we get that fair value or discount to fair value, I was basically just using that as an excuse to start locking away the trade, locking up the trade and finishing it off. And obviously since then, we obviously then started to see the end of trend. We started to go away from that. The short-term value went bid. And that was it. It was the game, set, and match at that stage. And that was it. That was the entire the overnight morning sell-off. Simple, easy to recognize, easy to trade, because all you were doing was waiting for the rejection of wholesale. And recognizing that we had this concept of excess, which is a low entropy piece of data, allowing us to make a swing, allowing us to make a decision about the fact that we are not trading in the supply-demand area, because if I'm trading demand, I'm buying it. But if I'm trading excess above demand by a substantial amount, and we're talking as I said, 250 cents, $2.50 premium. And because we're trading $2.50 excess, I don't think there's any, we don't see $2.50 excess. We're lucky if we see 10 cents excess or 10 cents discount on a normal trade basis. So to get a 250 cent excess on anything on oil ever is just, to me, is just crazy. So I think it was just simply just how much can we sell, when can we sell, how do we sell it, how are we going to manage to get into trades that are simply just collapsing without losing, but through the slippage of the trade itself. And we just have to be really careful we don't get ourselves stuck in a really bad price on a slip. So the one thing you're not going to do is you're not going to sell, for example, at 75.60s. Wait for the 75.50s to go offered and then wait for the rejection, just like we did at 76 on the bounce, just like we did at 75 on the bounce, and just try and stay short that oil trade as much as possible. Could it change? Of course it could change. We could get a comment about the Straits, and obviously the Straits getting closed is going to rip oil prices higher by $5 or possibly even as much as $10. And obviously that would bring potentially a pretty heavyweight coalition of other things coming in, other nations coming in, because they're in there now to protect their own shipping, and they're wanting that straits opened up, and we could obviously expect to see quite a significant pushback against that, and I think the Iranians are going to be very mindful of that as well in the background. So we're going to start getting into this conversation about finding things like this here, because this is a low entropy situation. This is an information situation. This is something that we can then say before we see any triggers, because the trigger isn't the entropy. The trigger is the information. Right? Entropy is the information. The trigger is still to come from that entropy. The entropy is not the same as the trigger. So what we're trying to do is trying to figure out the ways, and there are multiple ways. There isn't one, there's hundreds of different ways. That's the whole point of bank desk quants, isn't it? The whole point of their existence is to recognize that there are many ways of trying to establish that information flow coming through. We've seen paper after paper after paper after paper from Fed, from everybody else doing papers on this as a particular subject, and we'll certainly be adding to that discussion over the rest of this week.